Welcome back, everybody. This is Dan Pilla. We're going to be talking about negotiating with revenue agents, part two of our audit defense strategy series. If you joined me for part one, we talked about audits in general. We talked about some general principles of the statute of limitations and waivers and so on. I want to get into some specifics here about proving deductions. And one of the things that I want to talk about very first is the fact that lost records doesn't mean lost deductions necessarily. You know, we talked about this before that deductions can be or records can be reconstructed. And so this is what we have to understand is that just because a client doesn't have the records they think they need or you believe they need doesn't mean they're automatically going to lose the deduction. I always make an effort to try to reconstruct expenses. We're dealing with a situation right now where a taxpayer had a flood in the garage. Their washing machine upstairs burst a pipe, and the water gushed down through the walls and through the ceiling into their garage, right onto a shelf that, of course, had all their tax records in a couple of boxes there on the top shelf closest to the closest to the ceiling where because they're up there safe out of the way, right? And nothing can go wrong with the boxes up there safe out of the way. Well, what went wrong is the washing machine burst a pipe just above those boxes, and they got drenched, and the documents became destroyed. And the documents that got destroyed included their all of their travel expenses, the business travel expenses for the husband's business, and the medical expenses for the family. So we're in the process of reconstructing medical expenses right now and the travel expenses right now. And you recall from the first session that I said that taxpayers have the burden of proof, and that burden of proof can be met with reconstructed records. I cite a Treasury regulation there with respect to Code Section 274, which is a the code section that gives you the burden of proof with respect to certain records or certain types of deductions. It says specifically where the taxpayer establishes that the failure to produce an adequate record is due to the loss of records through circumstances beyond its control, such as destruction by fire, flood, earthquake, or other casualty. The taxpayer shall have a right to substantiate the deduction by reasonable reconstruction of his expenditures, right? So if we've lost the records, you have the right to reconstruct them. And I would take the position, frankly, that not only do you have a right to reconstruct the records, but I think the case law even creates a duty to reconstruct the records. I cite the Robbins case there on the next page of the outline, and that court decision specifically dealt with a guy who lost records, and he was whining to the IRS about having lost his records, and he couldn't prove this deduction or couldn't prove that deduction, and so argued that he should still be allowed to have those deductions because the record. Well, of course, the tax court wouldn't give him the benefit of the deductions without some kind of proof. But the tax court said the taxpayer bears the responsibility to maintain the records, and if he lost the records for some reason, that doesn't mean the burden of proof goes away. He should have reconstructed the records, is what the tax court said. So here we've got the court saying just because you lost your records doesn't mean that you can't do something to put the pieces of the puzzle back together again. And the question then becomes, well, how do you do that? I'll give you an example of a case I dealt with years ago, and in fact I talk about this case in my book, How to Win Your Tax Audit. The case of Kathy was a traveling salesperson. She represented a line of clothing that she sold to boutique clothing stores across the upper Midwest, Minnesota, North and South Dakota, Wisconsin, and Iowa. And she traveled around and sold clothing to these people. And she lost, through a series of moves that she encountered, personal moves from her home after a divorce, she lost the boxes of records that had all those travel expense records in there. And so she came under audit, and she had, $30,000 or $40,000 worth of travel expenses over those years. And of course, the IRS was poised to disallow all of them, but we went back and reconstructed all of them. And the way we did it is we used her credit card statements. You see, she paid for a lot of her expenses with credit cards. And so we were able to get the credit card statements from the credit card company. And then Kathy went through the credit card expenses, and she was able to identify the specific expenses that showed up on that credit card statement as a travel expense, because she could establish, for example, if she drove from Minneapolis to let's say Fargo, North Dakota. Okay, she spent 3 or 4 days in Fargo. We could prove that with the gas charges. We could prove it with the hotel charges, and then she could prove with her appointment book, which she did still have appointment books. She could prove that she was visiting these various stores in the Fargo area. And so using credit card statements, we were able to reconstruct these expenses, and it got so detailed that the IRS allowed all of the expenses, even though she didn't have a single scrap of paper to support any of them. Now, a key element to that was an affidavit, and we'll talk about affidavits in just a minute. But we use third-party statements. This can include bank statements, credit card statements, any supplier statements, any kind of statements from third parties that would evidence expenditures. Would be a way of one way to one way to start the process of reconstructing these records. So that is a starting point. These third-party records are essential in the process. The other thing that's essential in the process, moving to the next slide, is affidavits. You need affidavits to support reconstructions. And an affidavit is nothing more than a detailed letter of explanation that's notarized. The affidavit provides the foundation of evidence that's necessary to support the reconstruction. All right, and so I've got various elements of the affidavit that need to be laid out, but I want to show you that with I want to explain that with another example of a taxpayer I was dealing with years ago that lost a bunch of her records. She had a small business here in town, actually the town that I'm in, came under audit, and one of the things that was lost were her utility records. For whatever reason, she didn't have her utility slips, and was unable to get a statement from the utility company, phone companies, and so on as to what was paid. But we had about 4 or 5 utility slips over the course of a 36-month window, and so we used the 4 or 5 slips that we had to determine an average of what the expenses were. And then we projected those expenses over the missing, 35 or missing 32 or 33 months. All right. So we used the affidavit to establish the factual basis for the expense. In this case, the factual basis for the expense was that she was operating her business during that entire time, that she had she had phone bills and utility bills during that entire period of time, and that the phone bills and utility bills were consistent throughout that period of time. So there's the factual basis for it. I was in business. I had utilities. And then the specific nature of the expense was for the phone bill and the utility bills. All right. We stated the likely amount of the expense based on the facts. Well, we had documents to support what 4 or 5 of those months were. We used those documents to build the average. And so that was our likely amount based on the facts of the case. We have the historical foundation. The historical foundation is the fact that she was in business all that time. We attached copies of our relevant documents to establish credibility. In Kathy's case, we used the appointment calendars and the business cards. In this particular case, we used the utility bills that we did have. And then there's an affirmative declaration in the affidavit that the money was in fact spent. This is critical to a reconstruction. So you can't say the IRS, you can't say, and here's where reconstructions fail, or where taxpayers get tripped up with this stuff. They say, well, I must have paid the bill, or I might have paid the bill, or I think I paid the bill. I had to pay the bill. None of that is good enough. You got to affirmatively state that you in fact did pay the bill. So in Kathy's case, we stated clearly that she did in fact drive to these places, and she did in fact incur these expenses while driving to these places. And in the case of the utilities, the affidavit specifically stated that she did in fact pay these bills. She did in fact incur these expenses. So it's not speculation, it's not guess. And the more The more detail you have in your affidavit, the more explanation that you have, the more credibility that the affidavit has. You know, when you're vague and you're unclear and you're inconsistent, all of those things act to diminish the credibility of the taxpayer. Whereas the more facts and the more detail and the more information you provide, the greater the credibility of the taxpayer. And that's really what testimony boils down to. We're going to talk about that in just a minute here as to what constitutes acceptable testimony or not. Of course, as I told you in the last session, if you were with me in the previous session, I told you that the IRS auditors, that is, will routinely disregard the testimony of taxpayers, often because it's not presented in the form of an affidavit, for one thing. But for another thing, they always say, well, we can't just go on the basis of what the taxpayer says. We need documents to prove it. Well, that's just simply not true. The testimony is the evidence, and the greater the detail and the greater the specificity, the more credibility the testimony has, and the more likely it is going to be accepted by the IRS on the front end, or at least through the course of an audit process.